Welcome to StokTok's deep dive into Industrial and Commercial Bank of China Limited. This is one of the world's largest banks by asset base, headquartered in Beijing and serving millions of retail and institutional customers across mainland China and international markets. The bank generates revenue through traditional lending spreads, fee-based services, and treasury operations. As of May 8th, the stock is trading at $0.9 per share. Over the trailing 52 weeks, the stock has ranged from a low of $0.68 to a high of $0.92, placing the current level near the upper bound of that range. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Industrial and Commercial Bank of China Limited operates as a universal bank, meaning it engages in both retail and wholesale banking across personal banking, corporate banking, investment banking, and treasury services. The bank's competitive moat rests on several factors. First, its dominant market position in China, which provides scale advantages in customer acquisition and cost of deposits. Second, the implicit backing of the Chinese state, which historically has supported the bank during periods of stress. And third, network effects. The interconnectedness of Chinese businesses and consumers with the bank's systems creates switching costs. However, the moat has been eroding in recent years as regulatory pressures, digital disruption from fintech competitors, and slower economic growth in China have compressed margins and growth. Our StokTok score on Industrial and Commercial Bank of China Limited sits at 26 out of 100, which we rate as a void. The breakdown across 5 dimensions reads as follows. Valuation scores 7 out of 20, suggesting the stock trades at a significant discount to book value. Financial health scores 9 out of 20, indicating material balance sheet stress. Profitability scores 10 out of 20, reflecting compressed margins and low returns. Growth scores 0 out of 20, reflecting sustained revenue contraction. And smart money scores 0 out of 20, meaning no top-tier institutional investors hold this name. Now, valuation. The question every investor has to answer: are you paying the right price? Industrial and Commercial Bank of China Limited trades at a price-to-earnings ratio of 7.38 times on trailing 12-month results. The forward price-to-earnings ratio stands at 6.02 times, suggesting the market expects modestly lower profitability ahead. The PEG ratio, price-to-earnings growth ratio, which adjusts the valuation multiple for growth rate, sits at 1.01, implying the market is pricing in roughly flat earnings growth relative to the current valuation multiple. For context, a PEG ratio of 1 suggests fair value under traditional growth-adjusted metrics. The price-to-sales ratio stands at 3.22 times, meaning the stock trades at $3.22 for every dollar of annual revenue the company generates. The enterprise value to EBITDA multiple reads 0.00 times, which reflects that the bank's reported EBITDA figures are distorted by accounting conventions specific to financial institutions. This metric is unreliable for banks and should not be used as the primary valuation anchor. Let's turn to earnings. The most recent quarter showed total revenue of $228.66 billion against a consensus estimate of $673.39 billion. That is a significant miss. Revenue grew at 15.5% year-over-year, and net income came in at $86.94 billion, translating to a net margin of approximately 37 to 40% when annualized. This is a healthy margin, but the revenue beat, or in this case miss, suggests that analyst estimates may be misaligned with actual bank operational reporting, possibly due to differences in how deposits versus revenue are classified. Market sentiment around Industrial and Commercial Bank of China Limited leans decidedly bearish. Broader economic concerns about global trade dynamics and competitive pressures in China's financial sector have pressured valuations across major Chinese banks. Taking both signals together, we note that the bank trades at a substantial discount to book value. A 10-year median for Chinese banks hovers around 0.5 to 0.7 times book. Yet the current discount reflects genuine concerns about capital adequacy and return on equity going forward. A reasonable fair value range in our view sits between $0.75 and $1.10 per share, implying that the stock has limited upside to perhaps 20% from current levels, with downside risk to $0.6 if credit deterioration accelerates. The next earnings report is scheduled for March 27, 2026, which will provide an important catalyst to assess whether management can stabilize margins. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point checklist developed by accounting professor Joseph Piotroski to assess balance sheet quality, sits at 5 out of 9 for Industrial and Commercial Bank of China Limited. A score above 6 typically signals healthy financial condition. A score of 5 indicates mixed signals with material concerns in several areas. Specifically, the score suggests that while the bank maintains positive operating cash flow and reasonable liquidity metrics, there are concerns around asset quality, capital accumulation, and profitability trends. The Altman Z score, a model that combines 5 weighted balance sheet ratios to estimate bankruptcy risk, reads 0.00. This is an extreme outlier and reflects that the model's standard coefficients, developed for manufacturing firms, do not apply cleanly to financial institutions. Banks have fundamentally different balance sheet structures. They are primarily asset transformation entities, not product manufacturers. So the Altman Z score must be interpreted with extreme caution for banks. Instead, we look at traditional bank health metrics. The cash-to-debt ratio stands at 2.10, meaning the bank has $2.1 of cash and near-cash equivalents for every dollar of short-term debt obligations. This ratio is reassuring on the surface, but context matters. Much of a bank's funding comes from customer deposits, which are technically liabilities but not traditional debt. Interest coverage, earnings relative to interest expense, is not reliably reported for this bank, likely because the concept of interest coverage differs substantially for banks, where interest spread is the fundamental profitability metric. The current ratio, another traditional liquidity metric, reads 0.00, which again reflects that this metric is not meaningful for banks. The debt-to-equity ratio of 0.57 indicates that the bank maintains relatively conservative leverage for a financial institution. A ratio below 1 suggests that for every dollar of shareholder equity, the bank carries less than $1 of debt. Overall, the balance sheet is not in acute distress, but the low Piotroski score and weak capital generation suggest that financial flexibility is constrained, and that the bank may face headwinds in deploying capital productively. Next up, profitability. Is this business actually making money efficiently? The first metric investors should examine is return on invested capital, or return on invested capital, which measures how much profit the bank generates for every dollar of capital invested in the business. Industrial and Commercial Bank of China Ltd's return on invested capital reads 0.00, which is nonsensical. This typically reflects that the metric has not been calculated or that the underlying data does not conform to standard definitions. For a bank with $86.94 billion in net income, a zero return on invested capital is almost certainly a data artifact rather than a real signal. We recommend ignoring this figure and instead focusing on return on equity, or ROE, which stands at 8.89%. This means that for every $100 of shareholder equity, the bank generates approximately $8.9 of annual profit. For context, many developed market banks target 10 to 15% ROE over a cycle, while Chinese banks have historically achieved 12 to 18% during growth periods. An 8.9% ROE suggests that capital is not being deployed as productively as it once was, likely due to regulatory constraints on lending growth, competition from digital finance, and lower spreads. Return on assets, or ROA, sits at 0.70%, meaning the bank generates less than 1 cent of profit for every $100 of total assets. For a large bank with over $5 trillion in assets, this is an extremely thin margin. The net profit margin, net income divided by revenue, stands at 43.65%, which is deceptively high. This margin reflects that after the bank covers all interest expenses and operating costs, the remaining profit is substantial. However, this is less informative than for industrial companies because a bank's primary business is financial intermediation, not product manufacturing. More relevant is the operating margin, which reads 0.00, and the gross margin, also 0.00. These figures are not meaningfully calculated for banks and should be disregarded. The free cash flow margin, however, at 276.75%, is extraordinary. This suggests that the bank converts net income into cash at a rate significantly above 100%, which indicates strong operating cash generation and minimal capital intensity. Overall, profitability is compressed relative to historical levels, driven by lower spreads between deposit costs and lending rates. Onto growth. Is this business expanding, and at what rate? This is where the thesis becomes concerning. Revenue growth over the trailing 3 years stands at negative 1.50%, meaning the bank's top line has contracted slightly over that period. Over the 5-year horizon, revenue growth reads negative 2.30%, indicating sustained contraction. In the most recent quarter, revenue did grow at 15.50% year over year, but this growth is not representative of the trend and may reflect accounting adjustments or a favorable comparison to a depressed prior year quarter. The bottom line is that Industrial and Commercial Bank of China Limited has experienced secular revenue decline over a 5-year span, which is deeply concerning for a bank. Revenue growth is the lifeblood of a financial institution because it reflects loan origination growth, deposit gathering, and fee income expansion. Sustained negative revenue growth suggests that the bank is losing market share to competitors, facing regulatory headwinds that restrict lending, or operating in an environment where loan demand is simply declining. Book value growth over the trailing 3 years comes in at 7.10% annually, which is positive. Book value represents the equity capital attributable to shareholders, and 7.1% growth annually is modest, but reasonable given the compressed profitability environment. The dividend yield stands at 4.77%, which is attractive on an absolute basis. Many investors view bank dividends as a return on equity in a period of limited capital appreciation. However, a 4.77% yield combined with negative revenue growth and 8.9% ROE suggests that the bank is distributing a substantial portion of earnings as dividends rather than reinvesting for growth. This is not necessarily a negative. Mature, low-growth businesses often return capital to shareholders, but it signals that management's growth prospects are limited. In summary, the growth profile is decidedly negative on the revenue line, supporting only modest book value expansion and a sustainable but not expanding dividend stream. Now let's talk smart money. What institutional capital is actually doing with this name? According to our proprietary tracking of top-tier hedge fund and mutual fund holdings, Zero Guru investors currently hold Industrial and Commercial Bank of China Limited. This is remarkable. When we look across the Dataroma database of top-performing institutional investors, the names that have generated exceptional returns over decades, like Berkshire Hathaway, Fairfax Financial, or Third Point, not a single one maintains a position in this stock. This is a striking signal. It suggests that the most skilled allocators in the world have either never found the thesis compelling or have exited positions based on deteriorating fundamentals. Insider ownership, which measures the percentage of outstanding shares held by company executives and board members, stands at 0.00%. This is extraordinarily low. When management owns virtually none of the company they operate, there is minimal alignment between insider interests and shareholder interests. Insiders should have skin in the game. When they do not, it raises questions about management confidence in the business. Over the trailing 3 months, There have been 0 insider share purchases and 0 insider share sales reported. This absence of activity is not bullish. It suggests that management is neither accumulating shares at current valuations nor divesting in anticipation of weakness. Instead, it signals indifference, which in the context of a struggling bank is concerning. In the institutional market, the absence of Guru holdings combined with 0 insider ownership and 0 insider transactions paints a picture of a stock that has been abandoned by sophisticated capital. The message from smart money is clear. There are better opportunities elsewhere. And finally, the verdict. Let's bring it all together. On valuation, the stock trades at a substantial discount to book value and historical peer multiples, yet that discount is justified given declining revenues and weak return on equity. On financial strength, the balance sheet is adequate but not fortress-like, with a Piotroski score below the threshold for confidence and capital ratios that constrain growth. On profitability, net margins remain healthy in absolute terms, but return on equity of 8.9% and return on assets below 1% indicate that capital is not deployed efficiently. On growth, this is the critical red flag. The bank has experienced 2 consecutive 5-year periods of negative revenue growth, signaling structural competitive and regulatory headwinds. And on smart money, the complete absence of Guru holdings, 0% insider ownership, and 0 insider transactions over the past 3 months all point to institutional abandonment. In our view, a fair value range for Industrial and Commercial Bank of China Limited sits between $0.75 and $1.10 per share, representing approximately negative 17% to plus 22% of downside and upside, respectively from current levels. The most recent quarter's revenue beat is insufficient to reverse the secular decline evident in the 5-year data. Our interpretation of the data suggests that Industrial and Commercial Bank of China Limited faces structural headwinds from regulatory constraints on lending, competition from digital finance providers, and slower loan demand in a maturing Chinese economy. While the dividend yield of 4.77% provides some income cushion, investors should view this as a distribution from a mature, low-growth business rather than a catalyst for capital appreciation. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Industrial and Commercial Bank of China Limited. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.